Plains Angels was started in 2012 and is an initiative of the Greater Des Moines Partnership. The Plains Angels are a group of Midwest angel investors dedicated to providing outstanding financial returns while assisting early-stage growth companies by being an excellent source of funding and advice. Find out more about Plains Angels by visiting www.plainsangels.com.
So we're kind of ending the day today here with a panel discussion, and probably you've heard this before, but since this presentation today kind of mirrors one that we did in Coralville a month or two ago, the panel discussion, we've added some time to it, so hopefully you guys find it interesting. It seemed like people did over in Coralville, so we ran long, and in fact it was pouring down rain, so we didn't mind running long because none of us really wanted to go outside. But the idea of this panel discussion is to be very free-flowing, very participatory. So that's one way of saying that I haven't, and I'm not sure about others, prepared a whole lot for this today. Because what we'd like to think is that you will have questions and concerns and comments that you'd like to raise with us, and I think everybody on the panel would agree. If you've got those at any time, just kind of raise a hand and let us know what you'd like to talk about. Because I think the topic is sort of how to prepare your business for presentation to potential investors. Well, we can go a lot of different directions. There's a lot of talent on the panel, and so I'm just going to take a quick second. I'll give you a quick introduction of myself, and then go down the line here. My name is Chris Sackett. I'm the managing partner here at Brown Winnick. More importantly, I get to practice in the areas of the law that are most important for this kind of a presentation. So I work with lots of funds and investors and the portfolio companies that they invest in. So I get to represent lots of companies that are seeking funding or preparing to seek funding, represent the funds that are coming into those companies, and so seeing both sides of that helps me to understand how a deal should look, both from the investor side and the company side. Also do some M&A work and exit transactions, because a lot of the times the types of companies that you folks are most interested in today are looking to build some value and then maybe have an exit. So I have experience in that area as well. I have the pleasure of working with some of these folks, including Craig Gibson. So Craig, maybe you can tell people about yourself.
Well, thank you, and it's a pleasure being on the panel with these gentlemen. I know each one of them, and it's a pleasure to join them today. As Chris said, my name is Craig Gibson. I am the managing principal of Next Level Ventures, which is, it still seems to me to be a relatively new venture fund, but maybe it's starting to get not so new. We've been around since the end of 2013, so we're just coming upon our first year anniversary. We are about $30 million in size, so that is the size of fund we have and the amount of money that we're going to be putting to work. We're unique in two aspects. We only invest in Iowa, so to the extent there are businesses located in Iowa or with a principal place of business in Iowa, I'm all ears. And because of that, our investors receive certain tax credits and benefits, which certainly was instrumental in helping us raise the $30 million that we have today. So I look forward to your questions, as Chris alluded to, and sharing some of the perspectives that certainly I've gleaned from a number of years being in this business. Matt.
Thank you, Craig. Matt Busick. I'm with River Glen Capital today. We have two companies at River Glen. One is River Glen Capital. The other is River Glen Wealth Management. And at Wealth Management, we serve nearly exclusively accredited investor households who also have a will to put money at risk as angel investors in startup companies, private businesses, private debt, private equity, and but prefer to do so with our help. So we spend a lot of time helping angel investors be a little smarter about how they invest and where they invest. And so over the past 5 years, we've put about just under $9 million to work in a variety of private debt and equity across a variety of private businesses. We seek to invest primarily in seed and early stage deals, as opposed to these guys who invest in later stage stuff. We would, we look pretty much anywhere where we can drive. And that has meant that the vast majority of what we've invested in is local. And that fits our model really well because most of our investors are retired. They were A-type personalities before they retired, and they like being involved in these businesses if they can. So one of the other things that we bring to the table when we invest is potentially in our investor set would be somebody who knows your business or your segment pretty well. So typically we've invested in either med technology or ag technology broadly. And the deal size varies from the low end, $250,000 to as much as $1 million. I guess the largest investment that we've made has edged up toward $1.4 million, and not by design. A lot of times you get into these deals and you end up needing to have some dry powder that grows your size far beyond what you'd hoped initially. Dusty Thomas.
Sure. Dusty Thomas. I'm a managing partner with Midwest Growth Partners. Very similar age fund to Craig's. I think our announcements were probably a couple weeks apart from each other. And, we're focused on doing later stage, anywhere from late stage growth capital all the way through ownership succession planning across the upper Midwest. So we would be the latest stage fund on the panel today. My experience goes beyond that, though. I prior to co-founding Midwest Growth Partners, worked for CMA Ventures and still have portfolio responsibility there, which is the wholly owned fund of SIPCO. And with that fund, we did anywhere from seed stage investing all the way through some distressed turnaround deals. So really across the gambit of life cycles of companies, very opportunistic in our investment philosophy there. Still continue a great relationship with that fund through contracts and things like that. And today we have one deal under the Midwest Growth Partners banner, and then responsibility for about another 6 or 7. So have a handful of portfolio companies.
How do you source your deals? I mean, how do deals come to you? And start with Craig, maybe work our way down, and maybe as part of that, are there typical sizes or types of deals that you find yourself looking at or looking for?
And that's a two-part question. I'll tackle the sourcing deals. Raising capital for private companies it's an illiquid marketplace, as you come to find, and so it's very much we find deals through word of mouth. You can reach us if you pick up the phone or send us an email. But in our world, we find that the best opportunities really come from people that we know. Could be an attorney, could be an accountant, could be a banker, and or it could be somebody we've done business before, or somebody else that's active in the early stage community. It could be gentlemen that are on this panel today. So there are a number of ways that you can find us, but I would say, Chris, that the opportunities that have proven to be the most exciting for us have kind of come from a referral to us. And I think that's probably true in the business. Types of deals, we, as Matt alluded to, really look for later stage businesses, and by that we kind of look for companies that have meaningful revenue, and so that they've got some traction in the marketplace with their product or service. And our belief is they're looking for capital to really essentially add fuel to the fire, make the fire bigger. But we really try to stay out of businesses that are still at a proof of concept stage. I think there are a number of other funds, investors, and places to go to find that kind of capital that's probably better suited than we are. Our investing hypothesis really positioned ourselves as a little later, so that's how I would answer that question.
So finding deal flow, it's one part it finds you, and then another part you find it. So what we've done at River Glen is just try to get involved. with the startup community, and so there are a variety of things going on over the last 5 to 10 years across the state of Iowa, and particularly here in Des Moines, that you plug into, you'll bump into fast-moving companies that are in need of capital. So we're also active members of Plains Angels, which is Mike Caldwell's. I don't know if you crossed paths with Mike today. I think he's even co-sponsoring this today. But Plains Angels is a great place to see deal flow. The universities have all been fairly active, particularly the research foundations, both at the University of Iowa and Iowa State University, have intellectual property that they have licensed or patented, and they're looking for how to get that technology commercialized. So they're looking for seed and early stage investors like us to get that money off the ground. VentureNet Iowa is another great crossroads of deal flow. We've been heavily involved with John Marsh and that group. See Adrian's here today. Is anybody else here? VentureNet Iowa. But VentureNet Iowa, I don't know if any of the entrepreneurs here, I know Dan has crossed paths with VentureNet, looking for capital from the state of Iowa, but that's a great place for us to find companies as well. And then, of course, the network of other investors is critically important, including professional advisors who are being engaged, like the team here around Winnick, for referral for us.
Yeah, I think from our standpoint, and Craig alluded to it just a touch too, is who haven't we, or where haven't we sourced the deal? We've been tracking it really well this year, and it comes from just getting your word out as to what you're looking for. We've had some come in direct from websites, phone calls, business brokers, investment banks, kind of all across the gambit of service providers. But the really good ones do typically come from someone that knows you, knows your investment MO at least reasonably well. So we don't want them to gate a lot of the opportunities that could be good, but we want them to gate the ones that they know are going to be absolutely not a fit and can maybe steer them in a more appropriate direction. Some of the really good ones also come from other funds that aren't playing in the same space as we are, where they know our MO, we know their MO, and have a nice referral relationship back and forth. Those are also ideal. So I would say Iowa is a really great spot because you're going to get that where you're not a fit for us, but you should go talk to Craig. It seems like you meet some of his thresholds, or talk to Matt, or get deals that way too. So that's where we've seen a lot of our really good deals, is people that know us a little bit better than just reading the website.
And that's very, I think, illustrative of what goes on here. All three of us over the past year literally have either received a referral from one of us or referred on. So that's very true. And in fact, to be more concrete, if I look at, we've done 3 deals this year. The most recent one was a referral from the University of Iowa, was using University of Iowa research. The one prior to that came from Plains Angels. It turned out Dusty's fund was in there as well. So, and the earliest deal that we did back in the summer came from an investment banker who is known to the 3 of us as well. So it is a fairly tight community.
I'll just jump in and comment on a couple of things that were said. It is a very tight community. One of the things about Des Moines and Iowa and the Midwest generally is you're only 1 or 2 degrees of separation from anybody, right? And so that connectivity, that networking can be very valuable to you. It can help you to shortcut a lot of trips down blind alleys. You won't have those. The other thing I'd say about that connectivity in that small community is if you mistreat somebody, make a misstep, exaggerate, you can sort of offend the sensibilities of that community fairly quickly. So you want to be careful. You want to be discreet. But you should take advantage of that connectivity. And the other thing that kind of relates to that is I think what you've heard here is a warm introduction sometimes has value, right? If you've got a relationship, even if you know it or you suspect it may not be an appropriate opportunity for any one of these folks, but you know one of them quite well, I don't think that anybody in the investor world or in the professional services world has any problem with somebody coming to them with a good idea that may not be suited for them. I mean, I do a lot of just connecting people, and sometimes I'll call any of these guys here and say, look, I don't think this is probably a deal for you, but do you know who it might be a deal for? Flip side is, if I hear a deal that I don't think is a deal that is a deal for anyone that I'm associated with, I won't pass it on. But I'll usually let people know that. If I don't think that I can help one way or the other, I'll simply say, I'm not sure that I know where you need to go to find what you're looking for.
Can I add something that my mom told me a long time ago, and I think it follows on to what you said. You only get one chance to make a first impression. So I think what you're hearing is that the three of us on the panel, it doesn't take a lot to get a meeting with us. I think with a little bit of work, you're going to have an opportunity to tell your story, but I think we'll weave through that in this afternoon. You've got to be prepared, because that first time that we understand your idea, we hear the pitch, is going to be the most important few minutes that we're going to spend with you. And I think, being ready when you get the opportunity to make that presentation is important.
Kind of moving on to another topic, and I think the answer will vary for all three of you, what kind of level of control or majority versus minority investments are you comfortable making? If you're looking to do a deal, are you always looking for control? And continuing my two-part questions, and then what about co-investors? Let's talk about those kind of together. Craig?
I think each of us will probably give a little different answer to that question. We are minority growth equity investors, so we do not do and have not done in our prior fund a change of control investment, so we seek to take anywhere from 10 to 30% of the equity in exchange for a check. But in doing so, we're going to want some minority rights, and those are things that typically get negotiated during an investment round. But they're things like, you're not going to move out of the state of Iowa if you've promised you're going to stay in the state of Iowa. If we're investing in a shoe store, you're not going to change it into a donut shop, if you will. So there are certain things that, even though we are a minority owner, you're going to need to ask our permission. And really, those protections are designed to make sure that what we saw in due diligence and what you promised us is what's going to happen after you get the check and the round of money is closed. Is there a second part to your question that I might have forgotten?
Co-investors, how do you feel about having others come into
absolutely, and that, as I mentioned, the second investment we made this year, we serve on the board with Dusty here, and so we very much seek to participate with other investors in part of a round, and that's very much part of what we'd like to do.
Okay, we're linear.
We'll shake it up here in a little bit. Spice it up as we get toward the end here before 4 o'clock.
Don't want to spice it up too much when you're in a law office.
Exactly.
So I'll start with my answer to the last question first. Absolutely. In fact, hardly would ever solo a deal. In fact, we haven't yet soloed a deal. It's absolutely critical, I think, to have smart co-investors. Always look for co-investment. And then to answer the first question, this is where we're slightly different, because remember, our genesis is from a wealth management firm. So what we're doing is bringing in, I often refer to our model as herding cats. We're bringing in as many as 20 to 30 accredited investors into an LLC typically. So there's one level of governance that we control in that LLC. We're the managing partner of the LLC, or managing member rather, technically, since I have lawyers on my right. And we retain a fiduciary duty as a regulated investment advisor by the Securities and Exchange Commission to that compliance regime. So it's critically important that we control the LLC and its governance. But generally speaking, because we're definitely going to be a smaller investor typically in the round, We're not going to typically seek a board seat, although when we become a bigger investor, or when a deal has grown tired, maybe once you're in a deal for long enough, eventually serving on a board grows tiring. So sometimes it's helpful to have a new, fresh set of eyes on the board. So we've been swapped into a board spot in a couple of our positions. But for the most part, what's critical for us is information rights. So free flow of information in a private business is critically important. We'll typically look for an audit because there are certain safe harbors that the SEC affords firms like ours where we're technically not in custody of our client funds if we take it into a private investment, the LLC, and subsequently invest in a private company. We have to be very careful about technically taking control of that money. We don't want to do that. So what we typically use is a third-party custodian such as Schwab or Fidelity or TD Ameritrade to household the money. And then we subsequently make our investment, but it sits on a platform like that. And we require, as does the third-party custodian, a audit, which makes us potentially more costly to the company because as one of our demands, if our money comes into your company, we would require an audit or at a minimum a review from a third-party accounting firm on your financials. And all of that is simply honoring the duty that we pull our investors that once the money leaves and goes into your company's checkbook, that it isn't going, it's being used for the purpose it was designed to be used.
Is that one of the things that would, if I was an angel investor were to say I want to invest through your LLC versus invest directly in a deal, is that audit capability and that custodial capability one of the big reasons why they would do that?
I think so. Also size. Many, as you might expect, if you're a company trying to raise money, collecting checks $5,000 at a time when you're trying to raise $1 million is a yeoman's work. It's a lot of work. So, but a lot of accredited investors with, say, millions of dollars can't, using our methodology, afford to put the kinds of minimum investments that companies typically place on a private placement offering. Maybe that you can get into a deal for as little as $25,000, but when you look at the risk that you're exposing that $25,000 to in the framework of even a $2 million portfolio, which seems like a lot of money, it's too much risk to be taking in one deal. As an angel investor, I'm a strong proponent of the fact, or the idea that if you do one, you need to do at least a dozen. And if you're going to do a dozen, you got to be careful about spreading your total risk properly. Right? So if you think about it, if I'm going to do a dozen and I'm going to do $25,000 every investment, if I'm doing my math properly, that adds up to $300,000. And if I want to stay below, say, 10% of my total money in this kind of allocation, then I better have a $3 million marketable securities portfolio. So you can see that even though the SEC says you're accredited if you have more than $1 million, it becomes really difficult to do these deals unless you can get below what most deal structures require as minimum investments. That's why the LLC, where we make the minimum investment as little as $5,000.
Just a quick observation to piggyback on that. If you do angel investing, it's amazing how incredibly smart you can feel on one deal and how foolish you can feel on another deal. So you do need to, those are early stage investments, and they don't all go according to the playbook, right? And so that diversification is really important. Matt, just one follow-on question before we get to Dusty on this question. So when you do a collaboration of investors like that, that means your investors vary deal to deal, right? Yeah. And then would those investors generally speak to the company through you, I assume, versus 15 different, they treat it as though it's one investor with you as the conduit, correct?
So unlike my bookends, who are more traditional private equity investors where they've raised a fund and gain, in his case, 30 million, I think you're 30,
41.
40. So a lot of money is committed to these two in the form of a fund. Each investor remains the same across the fund's life. Our model we adopted is what's called a master limited liability company. And what that allows is when we decide that we want to make an investment, say in company A, we'll issue a series in that master limited liability company and populate that with a unique set of investors. Series A in our master limited liability company may have a different membership group than Series B and so on. So the concept is, if you're a client of a wealth management firm like ours with a will to put money at risk in these kinds of deals, you still retain the right to like the company that we're investing in first LLC, not like the company in LLC B, so opt out, but then go into C and eventually string together the portfolio that is properly diversified for yourself in our model. Where if you invest in a fund like theirs, which, you know, in hindsight probably is smarter. In hindsight, it's a blind pool, and you're really choosing to be in that fund, and they're going to make the selections. You'll never have a chance to decide whether or not you like what they're investing in. In our model, you do. But once you put the money in the LLC, what you're doing is delegating communication to River Glen. We're the ones who communicate with the companies. And that's good for the company, because the company doesn't want to have 30 people that they have to talk to.
Yeah, I can say from representing lots of companies that have raised angel funds, if they have a really small minimum, I will counsel them against that, because, you know, you got to pick up the phone. When the investor calls, you got to pick up the phone, and if they're in for 10 grand on your $10 million raise, you got to pick up the phone, right? And that can eat up your entire day dealing with shareholder issues as opposed to operating the company. Yeah.
But what you've just described is people don't know who all is necessarily in those groups. And you're really the person who's going to hammer on the investee, right? Not those individual people who would have put in 10,000 or 25,000.
Right.
Is that correct?
I think so, if I understand your question. There is some visibility and transparency of the membership
Okay.
by definition, because you're party to a true entity. You're an owner of something, the
Okay.
LLC in this case. And there are disclosure requirements of the LLC, one of which is whom I invested with.
Right, okay.
And so that's driven by the operating agreement of the LLC, which is separate from the governance documents that drive the company. But yeah.
But aren't those people more likely to call you than the company that they've invested in, or no?
Yes. Yeah.
Okay.
Yeah, they rely on our team to provide updates about how the companies are doing. If they have a question pertaining to one of the companies that they're invested into our LLC, they typically call us, and then we turn around and call the company. But to build on my answer from before and your question, I'm sorry, I don't know your name. You look familiar, though.
Casey.
Casey. Okay. What's your last name?
Neiman.
I would have. You look familiar. I'll track down where. I'm better with faces than names. The other reason why our LLC structure works for individual investors, there are lots of reasons. One is lower minimum investment. The other reason is because we pool money, then we have a better chance of winning preferred terms. And if I'm a $25,000 investor in the midst of a $2.5 million round, I'm probably not going to swing the deal terms much. But if I'm a $5 or $6 or $1 million investor in that $2.5 million round, we're fronting, maybe 30 investors who add up to that much money. I can command better terms when I invest. Meaning, it could be everything from valuation, it could be information rights, it could be protections of liquidity. All that is important and gets lost if you're a small, $25,000 investor.
Yeah, and if it's your $25,000 and you don't have somebody that you know and trust who wants to be involved in the communications and reviewing the monthly financials and maybe participating in management calls, it's kind of got to be you, or else you have to just sort of let it go. And I don't think that most individual investors want to just let $25,000 investments go. So, Dusty, how about what do you guys look for in terms of majority versus minority interests, and how receptive are you to co-investors?
Sure. I think the answer to the first question is it depends on the deal. So we're very flexible in our mandate. So the first deal we did under our banner was we owned over 90% of the company. Our co-investor was management, so really no true co-investors in that deal. And then if we're doing what we would call a significant minority deal, call it 25% plus of the equity, happy to have co-investors. We're going to have less punitive rights. We're not going to control the board, but we'll be an active participant in it. But the short answer is always going to have a board seat, always going to have a very strategic say. Doesn't necessarily have to be the controlling say in a deal, depending on sizing and type and those things. And co-investors, it just kind of depends on the deal. If it's a really specific thesis that we're working on and backing a CEO or something like that, then it's a little bit different than a deal that is maybe you're on the growth capital side, and there's lots of influence that can be brought in. And also we want to make sure that we're going to get the right allocation for our investors in our fund as well. So that all comes into play in kind of the calculus of the co-investor relationships.
Well, I can speak a little bit to co-investors from the angel perspective, and that is if you're an angel, like anyone else in the world, you have certain things that you know a lot about and other things you don't know as much about. Just because you don't know as much about something doesn't mean it's not a wonderful opportunity. But I'll tell you what, I like to feel a lot smarter by having a certain group of people, or it's not everybody, but there are some people that they tell me, hey, I really like this deal, I'm getting into it. And it's an area that I first of all, I know them, I trust them, and they know that area better than me. Then they can sort of dumb it down for me, if you will, and validate what I think is maybe the case. Or if you've ever sat in a pitch where you're sitting there either feeling very positive or very negative, doesn't really matter, about the presentation and the company and the opportunity, and then others start asking the hard questions, you might do a 180. You might find that that is something I am interested in now that I've heard someone else, or vice versa. So I tend to think, on the angel side at least, well, you're almost always going to have co-investors on the angel side, but it's a good thing, right? If they're people that you know and trust, and you get a better understanding of the company and a better dynamic due diligence process.
On that too, Chris, one thing that's a big plus for the earlier stage companies, whether it be those guys putting their money in, or maybe it's someone really knowledgeable that doesn't have a lot of capital but is taking an active advisory role, or maybe they've got an option package or some kind of incentive there and knows the space, has a reputation in the space. That's a big win for investors and also for the company. Oftentimes they have that advisor role, whether it's a small amount of capital or a large amount of capital. Having some kind of active state can be a big win.
Maybe let's follow up on that. So what do you think about management and founders that having skin in the game? How important is that to you?
Just looking at the deal we just did, that was vitally important. It was in our LOI from day one, and unfortunately at the tail end of that deal, the majority ownership that he was working for kind of pulled the rug out from under him, but he still stepped up and hit his commitment, and that was big for us, and it was part of our deal from day one. So a lot of times some early founders don't have the hard cash, but they've put something in that is significant to them, and that's a requirement in almost every deal we do, that management has. Could be $10,000 in some case, could be $1 million in another case. But it's significant to their individual situation. It shows that they've put their stake in the game, and that's a requirement in all of our deals.
And I think that's an important point too. I mean, what's the skin that's in the game is going to vary depending on the founder and what they can do, right? If it's a multi-bazillionaire and they put 5,000 in, that's not particularly meaningful. But if it's somebody who's working every day and deferring pay and put 25 or 50 in because that's what they've got, I think that is in some ways just as meaningful. Right? Matt, what do you think about the skin in the game concept?
Well, there was a question back here, Chris, real quick.
Well, I just had a couple of questions, actually more for you, on the seed funding. One, I haven't really found any other people that are like you. I mean, you're the first person that I really ran into that like offers more of a seed funding. So I was just kind of curious on, now we're kind of talking what I wanted to know about, like the skin in the game and what this is kind of where I was going actually, on what we're looking for what we need to have to, for startup. I've been bootstrapping my business now and looking at a new startup for what we need to have for skin in the game and what you're looking for those type of things. So actually you were the person I was looking for. You.
Yeah. Is somebody, if you have an emergency?
No.
Maybe it's about number
Maybe
eight.
it's my wife, I don't know.
I don't have ear devices, but I just can hear something, it's like that. No, skin in the game, hugely important. It goes to character, right? It goes to trust, and when you're a seed investor, it's a leap of faith. First of all, most of the time, the way deals are structured, you're a minority interest owner typically. So that is to say, if it's your baby, you need money from somebody like us to get off the ground for whatever reason. You don't want to sell your baby entirely, right?
Right.
So that puts us in a really interesting position as investors. Philosophically, we need to feel like we understand, know, and trust the entrepreneur who's trying to get this thing off the ground. And a huge part of that is understanding the incentives, right? And the willingness to take on risk, which is another way of saying skin in the game. And I agree with what Dusty said. If this is your first business and you haven't had a win yet and you're relatively young, or this is your fifth business and you failed 4 times, and as a result you've got no money, or it's your first business and you're in your 60s and you've been through a divorce and you're trying to get this thing off the ground, all that context matters in terms of gauging what the appropriate level in the game is. Chris said it best. In my view, if you've got a ton of money, why are you asking me for money? Would be my question. How much do you really believe in it if you're not willing to fund it on your own, if you've got the money to do it? So I'd be less likely to invest in a deal fronted by somebody who's got a ton of money and they're asking for mine. That's voting the wrong level of confidence, and I'm not seeing the trust that I would want, as opposed to somebody who has no money. And during diligence, we find that out. Part of diligence is, when you ask for money from somebody, you need to be willing to, you're not going to undergo the same kind of treatment I take on when I go to see my doctor, but you are going to definitely...
Just short of that.
Yeah. You're definitely going to want to understand that we're going to look closely at everything. So if we learn that in diligence that an entrepreneur really led us to believe that they had less money than they actually have, and that's going to be thumbs down during diligence.
And you have to be ready for those questions with a crisp answer, because they are going to come up. So I think what you're hearing is skin in the game is a relative question for everyone. But I would encourage you asked about early stage places to go for early stage capital. I actually think there are several in the state of Iowa. There are active angel organizations. There's Plains Angels, where you can apply, get access to an audience of accredited investors in Des Moines, Iowa, or Cedar Rapids. You can go to both, if you will. The state of Iowa has wonderful programs with no recourse loans for...
Well, I was going to say no loans, because I have issues with loans. So
Well,
that's been my issue, is I can't get a loan.
Then, well, the state of Iowa can be a friendly lender that if commercial opportunities are closed, the state of Iowa is a little more flexible. Because why are they doing that? Because they want to see business growth in the state of Iowa. And even though you may have an experience with commercial lenders and not meeting their underwriting standards, you may still find that you meet them with the state of Iowa.
If you're not getting traction, ask people why. Because if you can go to a ton of meetings with really great people who for some reason or another will choose not to invest. And then you find the one you need, you get an investment, that's great. But if you get feedback, particularly if you get consistent feedback, if you get people who say the shortcoming or the problem is X, and you hear that more than once, then it's probably X. and you probably need to address it. And the other thing about this connected community is once in a while you'll see or hear of companies that you, the people that are in the know, if you will, know the feedback they've gotten and know that they haven't taken it to heart. And I will tell you that if those stubborn companies that sort of keep coming around and trying to explain why you're wrong for not investing are not going to probably get those investment dollars. I'm not suggesting that your company at all, I don't know what your company is, but you'll listen to that feedback and you won't always get it unless you ask for it. But I think you want it, you know, if somebody says, they may not even say we're not interested right now, but if they seem not interested, it's a perfectly fair and appropriate question to say, so what do you think? What are the challenges that I have to face? And there are lots of companies that benefit even before they're out looking for dollars. They do kind of these practice pitches, right?
I haven't started pitching it. I just got out of venture school with some of the others, so I mean, I haven't even started that round yet. I've been working with Mike, and things like that. So, I mean, I just barely started that yet. So I know I'm just barely looking for the seed funding. I've talked to, John LaMarche and things like that. Most people have said, you need seed funding. Next Level Ventures is, higher up. I'm not ready for that yet. So I know what I need. I just haven't started that yet. So, and I've heard other people say, that maybe that's not my round. Maybe I should, try to do sales on my own and not go for funding yet. It's better not to seek funding. So I don't really know, and that's why I'm here.
Well, then it sounds like you're going to the right resources.
You are.
You're going to the people who will prepare you and give you the feedback that you need before you go. Because again, one chance to make a first impression.
Right.
If you go out with the, there's a difference between a pivot and a really bad idea, right? And so if you're going out with something that people are just going to say no, and they're going to remember that, no, that wasn't it, versus they're going to say, well, what I think you need to do a little differently is this. That's constructive and useful to you.
Thank you.
And you hit on a comment too, that the best funding source in the world are paying customers. So if that's a way you can get to where you need to be, even if it's bootstrapping early on, it sounds like you're taking that approach to date. I mean, that's I would love to be in those shoes where paying customers can help me, even if it's a little slower, get from point A to point B, not have to deal with the funding process, because it is an incredibly distracting process, and I think anybody on this panel would say it takes your eye off the ball from a lot of things you want to be doing, a lot more than talking to guys like us. So if that's an avenue that can hit it, I would pursue that.
That's true even when you're talking to all the right people and a number of them actually write checks. It's still, for 60, 90, 180 days, takes your eye off of the prize, which is operations and revenues, right? If you want to know what the most expensive money is that you're going to try and source, it's that money you're trying to source when you don't have revenues. So if you can go get revenues, the amount of your company, the dilution you're going to give up is going to come down dramatically. So.
You always need to leave yourself open. I think this is for everyone in this room. You've got to leave yourself open to the feedback that is going to continually come from the marketplace. That's your customers, that can be your bankers, that can be your equity funders. And I think that's, Chris touched on it. You are going to get that feedback. And we say no, in our firm we say no a lot more times than we will ever say yes. But every time we try to give people feedback of why. What can they do to improve their business next time they come and they make a pitch. And there are some we know within seconds if they're open to that feedback, and there are others that are not, frankly. And I think those that are successful have to be open to it, but it's certainly not everybody.
Honestly, if you're in one of those meetings, and normally when I'm in those meetings, oftentimes I'm in there as a counsel, in a counsel role, could be for either side. But if I'm counsel for the company that's seeking investment, and I hear them arguing back to every point, I want to kick them under the table, right? Because we're just doing damage. Once you've done it about the third time, the investor's saying, well, it's my money.
Right.
And if you don't want to take my feedback, then I'll just move on.
Right.
So, how about kind of the horse versus the jockey thing? What would be, and of course the answer can be both, right? But what's most important? Maybe we'll start with Dusty this time.
Sure. Well, that's a difficult question, and a lot of it depends on the space and the stage of the company. As we're looking at later stage deals, it's got to be a pretty good business first, and the jockey can be a little more interchangeable depending on skill sets needed. if it's earlier in that life cycle and there's going to be a lot of pivots yet, you know, the horse has got to be at least okay, and there's got to be at least a sound product or something somebody's going to want to pay for, but the jockey is going to be vitally important to be able to pivot and not just, you know, there's running through the brick wall to get something done, and then there's running through the reinforced concrete wall that's never going to budge, and it's just going to be really painful for everybody involved. So betting on the jockey, someone that's going to be flexible and can put the hours in that earlier stage is probably more important. So that, I don't know when that continuum changes, but along the life cycle of the company, it's going to start to flip more to the company being sound.
Interesting, yeah, I haven't heard it articulated that way, but so there comes that point where you got the strong horse, you can find another jockey.
Right.
Okay. What do you think, Matt?
Well, at the risk of deviating from your question, I'm going to answer it.
Or you do such a thing.
Yeah, I know. I'm going to actually answer it slightly differently, using the same theme, okay? Horse, jockey, weather, and time of day. So,
Time of day.
is that all right? Can I answer?
Absolutely. Yeah.
So, I think I would say exactly what my esteemed colleague would say about jockey and horse. But what I would say that I've grown to believe is even more important than horse jockey is timing. And weather means macro environment. And the two are kind of inextricably intertwined in my view. So you can have a great horse, but if that horse is in a great jockey, but if you're starting a race at 5 and that horse happens to be really good in the morning, but not so good at 5, you may lose the race anyway. Likewise, if the horse only runs well when it's raining, or vice versa when it's not raining, you can be screwed. Pardon the expression. So I think one of the things that I've grown to respect even more than the basic blocking and tackling of understanding product or engineering, you know, defined broadly, what is it that you're doing for a product or service in a business, which absolutely has to pass the test. Team, absolutely critical, but timing, man, you know, timing can really hurt you as an investor because I think it's wrongly ascribed to Albert Einstein, this notion of power of compounding returns. I think that is folklore. I don't think it really is his deal. But when you put money at risk the way we have to, the clock is ticking the second the money goes into your company. And if the timing doesn't work out right, even a great deal can be a lousy deal, a mediocre deal. And a lot of times timing is a function of the environment. So you've got to get the macro environment checked correct too.
Would you say it's I can think of one or two exceptions, but it's almost always a race, right? I mean, if you've got a good idea, the faster you can execute. There's the rare occasion that you do see once in a while where people say, well, that was just an idea before its time. That can be the case, but for the most part, I tend to think that in terms of efficient use of capital and execution, if there is an opportunity that's out there now, it's out there now. It may not be there next week, and there's probably somebody in a basement office somewhere working on your great idea. So, do you think, Craig?
You know, I'm gonna pick the jockey every time. If I look back in our career, you know, we had 14 investments in the last fund. We've got 3 now into this fund, and you know, I would say one of the truisms that's come out of that is, you know, we've been through many pivots, but those that have made us money have always come from a management team that has been able to go through a wall or figure it out. And so I would actually pick the team over the idea anytime. You know, and we spend a lot of time getting to know people before we write a check. Due diligence can go anywhere from 3 months to 6 months, you know, depending on if you know, there's a pause in the process. But all of that time, we're getting to know the people that we're going to get into bed with. Because once we get married and the money changes hands, we're married now for quite a few years. It's not always going to be up and to the right. There's going to be some moments. There's going to be some dark days. It could be a macroeconomic recession. We had to go through that with a portfolio of companies in 2009. That wasn't any fun at all, but we got through it, and we got through it with great management teams. So I will always bet on the jockey before the horse.
Okay. Any particular, if you were to name, say, one quality, and this is probably limited, if you're looking at a founder or a CEO, is there any particular, can you say one quality that's the most important one, you think?
You know, the easiest answer to that is somebody that has been there and done it before. You know, the odds of being successful in this business, if we look at a track record and somebody's had a successful exit before, they're more likely to have a successful exit again. Sometimes it can be a deal where they didn't make a lot of money for themselves because they gave out all of the equity too early. They made some mistakes along the road, but we give them full credit for that. Next time they go out and build a business, they'll be a little more savvy in how they structure the equity. But that is a big, green flag when we see a team of people. It could be one, it could be a group of people that have built a business before, had a successful exit. We're all over that.
Dusty, what's the biggest mistake you see? Somebody has I don't care if it's a new company, an established company. What's the biggest mistake in terms of the company when they come to you?
Yeah, I would say there's one fatal mistake in coming to us, and then there's a lot of common mistakes that I see. The fatal mistake is kind of tagging on what Craig just said about this is a marriage. This is, sometimes this deal is going to last longer than a lot of average marriages. So don't expect the check to get written like the next day after you had the meeting and showed us a really fancy PowerPoint. That just is a fatal pet peeve when you start putting pressure and try to take the ability to say no later on. That first meeting is great, and we can sort out a lot of stuff we aren't going to invest in and give you the quick no. But if you're expecting the quick yes, you should have started 9 months ago, or maybe a year ago. So that's my kind of fatal pet peeve that just drives me crazy and happens way more than you would ever think. But some of the stuff we run into a lot.
Is that usually a factor or a result of desperation or impatience, or both?
I would say probably desperation, typically more than impatience, or someone that is afraid to put their own capital at risk, which goes into other themes that have happened today. So typically it's more desperation, but sometimes it's just impatience, and they've watched too many episodes of Shark Tank and feel like that's how it works. So,
no, my pitch, where's my check?
Yeah.
One of you writes a check, right?
So that would be one thing that just drives me crazy. Not realizing that we've got a long-term relationship with our investors, and we want a long-term relationship with you, and it's really bet on you. So that's the fatal mistake that I would call out. And then there's two really common ones that are common mistakes that we run into. The first one is typically more of an early stage mistake, and that's not understanding the difference between your addressable market and then the really broad kind of industry segment you're targeting. So a lot of signs of this mistake are if I only get 1% of the market or 0.1% of the market. That's like the somebody bumping into the jukebox and knocking the record or CD off. If somebody says that, it's just an instant stop in the meeting almost, because they obviously don't understand how they're going to go to market and what it's going to take to get there. They're just picking an industry statistic they found in some industry report and saying, well, if I get 1% of that, that's $1 billion, and obviously this is a market-changing opportunity. Well, that addressable market for you might be $10 million, and nobody's going to want to do that deal unless it's, you can exploit that niche on a recurrent basis. So I would say that's an early mistake that I see really common. The later stage mistake that I see really common is when we want to talk about profitability and things like that, and they keep wanting to talk about revenue, and then we still try to get back to, so what are your costs, and how are we going to build this up, what's profitability? Well, I got this kind of revenue. But they obviously don't know what happens below the sale, and they either need a lot of help on the team side, or they just haven't really thought through, how do I get to the next stage beyond, I'm making some okay money now, but I don't know what that next dollar of revenue is going to drop to the bottom line. So that what I say is a little bit more of a later stage mistake that I see fairly commonly.
Got it. What do you think, Matt? What do you see as big mistakes, common mistakes, pet peeve mistakes, whatever?
I actually tried to think about this question because I
Well, this, I guess, would be more, to use Dusty's parlance, would be more of a common mistake. I think it's critically important not to be too informal too soon. So what I mean by that is, when you reach out to an investor, I think you want to begin the way you were taught to begin, or at least I was taught to begin. I'm getting old now. So you start with sir and ma'am and stay formal until you give them permission not to be formal. And that means everything from the way you communicate in an email, the way you conduct yourself on the phone, the way you follow up with please and thank you, and all of that really sets the tone for respect, which builds trust. And you can't get to trust without respect, and you can't get to respect without the small things that mom and dad taught you when you were little. So that, to me, is a mistake that I see made over and over and over again, and it's sloppiness. It just leads me to worry that I can't trust the person I'm investing in down the road.
Are you, any baseball fans in the group? There's the movie Bull Durham where the guy's got fungus on his shower shoes. He says, when you get to the show, that you can have fungus on your shower shoes and they'll think it's quirky or
think you're
but,
colorful.
until you get to the show, it just makes you a slob.
Yeah.
It kind of comes into play.
Yeah.
Yeah. Great. What about that?
Unrealistic expectations of value can be a showstopper, and I think it goes back to, you got one chance to make a first impression. If you're an early stage company and you come through the door and you've got, one or two people and a great idea and you want $10 million of valuation, you might not even get the full meeting that you set up for. And there's naturally a give and take in that discussion. There's going to be a healthy negotiation around value, but don't pitch it so high that the deal is dead on arrival. That happens often. And, goes back to socialize the idea. A young lady in the back's talking to people like Mike Caldwell. There are people that are going to be able to give you some ideas around value. Great attorneys, of which there are in this room, are going to be able to say, well, this is what I've seen happen before, but have a realistic expectation of what that value is before you walk in the door and you lay it on the table.
You know what I sometimes tell clients about value is the most important thing is that you have an answer and you have reasons to back it up. As I tell them, your number is far less important than having a reasonable basis for why you came up with that number. That number is always going to be subject, if you're early stage particularly, it's always going to be subject to criticisms and counter arguments, but have a number and be able to defend it. And then don't defend it stubbornly beyond a certain point. What I would say is that I think can be somewhere between fatal and near fatal is integrity issues would be fatal, I think. If you go to prospective investors and anything that you've tried to cover up that's different than an inaccuracy. Inaccuracies are bad, right? If your financials have problems mistakes in them, that's very bad. But if you're trying to cover something up versus accepting the challenges, the weaknesses, maybe some mistakes you've made, I think you are far, far better. I think maybe it's human nature, but if I meet with someone and I feel like out of the chute I can't necessarily trust them, I'm certainly not going to write them a check.
I want to hit an example on that, Chris. So we, especially with the larger deals we do, we'll run a background check, and nothing out of the ordinary, but we had a deal we really liked. We got down the gate and then slid that form across the table, and really frustratingly so, this guy had a felony charge in his background, and it was easily explainable once we walked through the scenario. You could document it, all that kind of stuff, but it came so late in the game, and it was so frustrating because it had a material impact. It had a money effect to it, which again, easily explainable, and I'm not saying he's a bad guy, but had he disclosed that day one and said, you're going to find this, and if you don't, I want to put it out there. Here's the explanation around it. Here's some folks you can call to verify this story, including the ex-employer that had the issue and things like that, it would have changed the game. But the fact that he was just kind of hoping we didn't find that and didn't bring a question, I mean, it was a good deal. It was a deal we would have funded. And it just stopped the game because you could just tell he was hiding it, just hoping we wouldn't find it. And, it would have changed the whole outcome had it been disclosed day one. And just talk about it.
And think about, that problem never would have gone away even if you had written the check, right? That comes up after you've written the check. It's with the marriage example, it's, honey, you got some explaining to do, And yes, you're in the deal, but boy, the partnership feeling, that honeymoon would wear out real fast.
No, just as I said, we do background checks too, and you find out an amazing amount of information, but a drunk driving conviction when you're 21 isn't going to disqualify an investment. A bankruptcy, if there's a good reason around it, isn't going to disqualify investment. If you stole money from your employer in your last job, that's probably going to disqualify the investment. But, get that information out on the table. As Dusty points out, it killed the deal he was looking at.
Right.
But there's a story, and if there's a good reason, we just need to understand that.
One thing about the diligence process, I'm starting to look at Rick, is once you're in the diligence process, I can probably speak with all these folks agreeing, surprises in diligence are bad. I feel like once you're into the diligence process, particularly when you're negotiating kind of the terms of an investment, don't surprise your investor. Treat them almost like they're already in and on the board. Hey, we're thinking about this contract, but we don't know. It would commit us to something. What do you think? You don't necessarily have to do what they suggest, but you've run it past them. Milt, I think you have a question or comment.
And this is rewinding a little bit, but I was going to ask you about the merits of an entrepreneur having sort of pre-funding conversations with you. Would you rather that they have their act together, their funding documents and their presentation all ready and give you their best pitch on that first impression? Or, I know it's going to be a year before I need money, but sit down, have coffee with you, generally talk on a more informal basis about the business and engage what would you want to see, how could they improve it in the next year that would make you more interested? Which of those camps do you fall into?
It's a great question, and I think the answer is both. My advice is free for the price of a Starbucks cup of coffee. And, I think it's the setting. So there's, I go to a lot of networking events. I'm all ears if somebody wants to grab time and say, what do you think of it? Because I think then you're setting the context. It's a trial balloon. And I can give quick reaction, and I think all of us probably make ourselves available for that kind of informal interaction. But if you set the stage and you want 1 hour and the expectation is the pitch deck's going to be ready, then it's a formal setting, and there's going to be quick questions going across the table, and you've got to have a reverse presentation, or you've wasted everybody's time. So absolutely, those interactions can and should happen and should be part of, the elevator pitch that anyone looking for money, should be able to have your message condensed down to, 2 or 3 minutes. Why do you have a great investable idea? If you can't convey that in a 2 or 3 minute session, you need to keep working on it.
So the only thing I would build on is it costs you, I prefer 25-year-old Scotch. Anyway, Culver's chocolate shake. So my answer to that question is, again, slightly different, just to not simply say the same thing over in my way. I think that a lot of times we worry too much or obsess too much about the value that we're setting at the start and not thinking about the value that we're driving to and what that's going to mean for me. So I think that the pitch, whether it's formalized and you've thought it through and you're ready to actually make a hard ask, or you're 6 months or 12 months before you're going to do that, I need the story. You need to convince me and make me a believer in your story. I need that story to come alive and understand what's in it for all of us. How do we all win on the back end? So then I can set in context, and we're good at math, and we'll do the diligence and figure out for ourselves what we think your business is worth today. But if you really want to have an informative conversation with me up front, it's make me a believer, preach, make me understand why you're going to go out and do something really spectacular. And what is that going to mean for if you're successful? It's the vision that you need.
I like that question because a lot of people gave me their cards, like you guys, like John LaMarche and things like that at startup, but I wouldn't want to waste your guys' time, you know, even asking you out to coffee, because I'm not ready for someone like you. But what you just said is, sure, as long as it's a cup of coffee, but, I mean, I'm not giving you a big slide presentation. So you just said, sure, if it was just a quick meeting. So that's great for someone like me, because now I know, hey, I could call you up and say, hey, let's go have coffee and just chit chat a little bit.
Adding on to Craig's comment, make sure that when you're asking for the cup of coffee, what you're really asking for is the cup of coffee and not
Right,
to
exactly.
potentially turn into the full pitch.
We'd like an
and all
answer
that.
in the next hour.
Or if you're gonna,
Right.
or if you're gonna come back with the full pitch in, 2 weeks and it's trying to get that going, spend your time getting the full pitch ready, getting your info ready. But if you're truly 6 months or a year away from maybe even wanting capital, then it's time well spent. I know Craig's probably got a database, and Matt does, of companies that are kind of following along. And being able to see you hit milestones is good. If there's not really a milestone that you can prove out between now and then, probably just prep for the full pitch and set that stage and do that later on. So that would be my slight add, but I think the other panelists hit it right on the head.
So we've got 5 minutes, but we can go longer than that too. What questions do we have out here? Anything's fair game? Yes,
I
please.
was going to ask on building out projections. Typically, it seems like 5-year projections in an investment pitch. What are you guys' advice on that end?
Anybody who wants that?
Oh, that's one that you can hit out of the park. Your projections are always going to be wrong, and they're probably going to be wrong in one direction. So, part of our job is to, do sensibility checks and keep, we're going to ask, why do you think this? Why do you think that? Why do you think that? I actually, you're always going to have to put together 5 years, but, this year and next year are far more important to us. So, closer, near term, do you have a contract? How's that going to monetize? What are the levers here? Is it X dollars per unit? Why are you going to sell so many units? We're going to keep trying to deconstruct that and come up with a worst case scenario, frankly. And in our world, we're funding a business, and we want to make sure if we're funding it with our scenario of worst case, it's going to get 18 months down the road. You don't want to, write a small check and have it run out of money in, 6 months' time, for example.
One quick comment that came to mind I wanted to mention that it's sort of a pet peeve of mine, and we've had it a few times at Plains Angels, is people put their projections or their financials of some sort up there, and they just sort of casually say, yeah, well, that's wrong. But, and I think to myself, my gosh, you've got this room of people that you want to write checks, and you casually say that's wrong. It can happen, right? But sometimes they go into the presentation knowing they've got a materially wrong number, and I maybe have a stronger reaction than others.
No, you don't.
But my reaction is, I'm maybe close to done listening, So that'd be an important part of projection.
Can I want to throw in one tip that maybe people, I've noticed in these pitches too, is if you're building your projections off of your current year numbers and it's October and you have projected some amount of revenue for the year and you attain 25% of that for the year, I think that you have an obligation to adjust that number. So that happens way more, and maybe if you get away with it in January and February and you'll catch up, you're probably not going to make up that last 75% in your final quarter. And so, and I that's something that people, it's easy to jump on, and it's, and I can see, especially when your financial build off this year, we can add this much, and you're that far behind. You probably need to update.
So my answer to that question is the projections are important in as much as they provide a clue for your ability to think smartly about the assumptions that matter, right? And we can see in that list of assumptions what are you're missing some critical elements based on our experience, not that we're all knowing, because I've made plenty of mistakes and will make more. But I do think that it gives us an insight into the team more than it does to truth, right? So they're important, but they're not. How's that for an answer?
I'll add on a couple of points to both panels again. I'm going to emphasize Craig's point of the closer you are to today, the more important it is to explain why the revenue growth, those kind of things. So if that's just a rounded 20% growth on last year, it's just silly, because you obviously don't know how that 20% is going to hit. So at least make it some weird number that's like $788 at the end of it, so we know you're trying to do a build-up, and then don't get caught without the build-up behind it. It's still going to be wrong, but at least show who you think is going to come in there. And then future, when you're getting 3, 4, 5 years out, it can be a constant growth. We understand that you can't identify those. The other reason that, and kind of goes into Matt's point, the reason it's important to be able to do a 5-year projection is because we also want to try to look and see where those steps for growth are, where you're going to take on additional costs, additional people and personnel lines, those kind of things. If you're keeping a flat expense line that you grew 2,000%, unless you're in some weird niche business that I've never seen, that's just not going to happen. So you're going to need support, you're going to need additional people, salespeople, and if you're not projecting it, that's kind of what Matt's talking about, those vital clues that you don't fully understand your business or how you're going to get from point A to point B. So that's why those later years are interesting to us, is we want to know where the step costs are in your business from at least a structural standpoint.
Further questions?
You guys give the group an idea of what you think the average time is to get ready to raise your first round of money. Let's just say it's the person starting out, they've got some traction, there's enough there to make it viable. How long in advance, if they're going to go raise $500,000 to $1 million in earlier stage money, how long should they plan on that taking?
I actually think the earlier stage money is going to take longer than later stage. We tend to fund established businesses, so, the average time between us falling in love and closing the deal is going to be about 3 months. But I certainly have seen, and you probably have as well, people that are looking to put together $500,000, that can take a year, it can even take longer in some cases.
It's a hard number. That round right there, whether it's 250 to 750, is a tough round. It's high risk. It's probably angel, maybe not. Maybe it's a small fund. It is tough, and I think it's really important that you're meeting with the right people, because you can burn up 6 months meeting with the wrong people and having them introduce you to more wrong people. I can think of some companies here in Des Moines, some companies that have done very well, that burned up a lot of time talking to some of the right people. They just didn't quite know what they were looking for yet. So I suppose it depends on, sometimes people think, well, is the legal part the slow part? Not really. Not really. The slow part is getting people to say, yes, I'm interested and I'm ready to write a check.
I think the takeaway is whatever stage you're in, it is going to take longer than you think it is, and plan accordingly.
With the earlier stage capital too, you're talking to angels primarily, and it's tougher for one of them to want to take the lead and help rally the rest of the round, put terms around it, those kind of things. So it's going to take a lot longer than you think. It's not to go have a coffee shop discussion and get your checks. Where the later stage does tend to fall in line because there's more to validate, but it's easier to validate. You're not just taking that leap of faith in the really early stage business. So I would say early stage is going to take significantly longer, especially as you're really close to that seed stage, because you're asking someone to take a big leap of faith.
Especially if you're a new entrepreneur. I mean, the guy who's done it 5 times, that early stage money, he calls up 5 friends, and they write checks, and they don't necessarily even care quite as much as to what the next idea is. You made me money 4 times, so that can happen pretty fast. But if it's your first idea, it can be challenging.
What can really help there is if you've got a lead or an anchor investor, and those terms are really the same thing. And so, there are that we've touched on. There are places to go in the state of Iowa for more friendly loans. There are seed and angel groups. But where I've seen, and I think Mike would probably second, is those companies that have stood up in front of that group and say, I've got the first 100,000 and I need 200 more, and the price is this, and the anchor investors, Dusty said, has set the terms, then the follow-ons come a lot easier. And so think about that. What can really make the process go a little easier is if you've got a good anchor investor, the more reputable and more well-known the anchor investor is, the faster the money can follow. But that's an important consideration before you go into the groups, because there's not that many groups. So it goes back to be ready when you go before a Plains Angels or a VentureNet or before the state of Iowa asking for a $500,000 grant, because you're only going to get one chance to meet those groups of people.
And those anchors, if you have a good idea, which is a pretty abstract concept, but if you have a good idea and you've got advisors or friends or acquaintances, whatever, who kind of know the investment community, they might be able to say to you, that idea, if you can get this guy or this woman to write a check or to be a strategic advisor or something to buy into it, then you can get traction. I can think of a few people, I'm not going to say names. There are a few people around town that we would all recognize their names, and if they're in, okay, now I'm intrigued. Before I even hear what the idea is, if they're in, I'm intrigued, because I know they do their homework, and I know that they don't make foolish investments. So if you can find something like that, and you got to use your connections to do that probably, and your connections, if they think you're not ready for that introduction, they won't make that introduction. But if they're willing to make that introduction, that already says something, right? I mean, I don't know who the connectors are, but assuming that I sometimes have a role in connecting, I think with certain people, if I say, this is somebody I'd like you to talk to because I think it's worth your time, hopefully it'll get you a warm introduction.
We've used that same process with, go talk to this potential customer, and if they say that they'll buy it and legitimately put it on paper or talk to us about why they would buy it, then that moves the game a lot farther along too, where it could be an investor, which is great, or probably even better, but in lieu of that, if you've got a customer that says, yeah, if this is legit, I would buy that if they can perform at this cost, then that moves the ball a long ways down the road too.
So my answer to Mike's question is the quickest we've been able to do a deal, start to finish, 150 days.
It's fast.
The average is probably closer to 8 or 9 months from the time we start dating to the time we get to a term sheet, to the time we work through due diligence, to the time that we decide we're investing and we've agreed on terms, to the time that we draw the capital into the LLC, have that sit for a while, and ultimately get to close. So it's a beast.
And so if you're early stage, if you've heard of the concept of bridge financing, you're not going to get a bridge if you're a startup. If you're an established company and you're building out around, you might get a bridge. Or if you've got an existing pool of investors who are already in, you might get a bridge. But otherwise, your bridge is self-funded in that scenario. You've got to find a way to bridge yourself 8 months.
So getting back to equity ownership, like seed and angel investing, like what kind of ownership can we expect you on that kind of is there like a range and average control?
Can I take this one to start? So this is, I've been wanting to say this at a variety of moments throughout today, and this is a great, thanks for asking the question, because I think you want to understand what's in it, what our constraints are. What hurdles do we have to meet in order to understand how to answer that question? So our LLC structure is unique in the sense that it's co-joined with our wealth management operations. We don't have a traditional management fee the way a fund would in it. But we have operating expenses that we have to pay. So an LLC requires legal expenses up front to get the thing in place, and accounting and audit expenses ongoing in order to run it, as well as expenses related to communicating about the businesses. So we have to gather information about the business, we have to form some type of a write-up and distribute that. So, so just to put some math around it, that might cost $6,000 a year as a base expense, okay? So that means that when even though we waive the management fee, we also have a 10% hurdle, compound hurdle for our clients. So that means the money goes in, the client has to get their money back, including any money that we burned up for the cost of operating the LLC, plus a 10% compound return. Money doubles every 7.2 years. So if you're a seed or early stage investor, you're going to be in a deal at least 10 years. So they got, if we put together an LLC with $1 million, we got to get at least $2 million back in order to reach our hurdle before we get paid. So the answer to your question is partly a function of who's your investor and what do they need out of the deal in order to meet their hurdles. So for us and the mechanics of our stuff, we really can't afford to look at a deal unless eventually we're going to get at least $500,000 in play. So if you're starting out with a valuation of $1 million, you're going to give up 50% of your company to us in order for us to get that money in your deal. And I've got to believe that that $1 million post-money valuation is going to get to something on the order of $10 million by the time we come out in order for me to make any money. And more importantly, or as importantly, shoulder all the legal liability risk of honoring the fiduciary duty. And that's going to be true of these guys too, but just in different shades of gray.
So how do you get your control back how can the founder get back that 50% plus in the long term?
So I want to take this one too. Sorry. I love this structure. It goes to one of the questions that we never got to in terms of innovations. Understanding what your investors want out of the deal is really important because it allows for you to potentially build a call option into the docs, which allows you to retake control of your company. You may need financing to get out of the gates, but if you can dial up a call option that might be 6, 8 times my money in, that helps me get out of the deal at a win, huge win. I deliver my money back, your money back to my clients, they get a nice rate of return, and you, through the strength of your business, bought that capital back, and now you own it.
We're back to 100% and
Yeah. So I think, in my mind now, and I've been doing this a long time, which is hard to believe. Well, it isn't so hard, just look at my head. But to me, I really like that innovation in the docs, a call option for the entrepreneur, because any smart investor is going to ask for a put option. Which, is everybody comfortable with those concepts? I don't want to belabor the point, but I don't want your business to turn into a lifestyle business. I need a way out, right? So I'm going to want to be able to put my stock back to you. Let's say you're kicking along in a nice, positive cash flow situation, you're living well, but I got to get my money out. I need a liquidity event in order to honor my duty back to my investors. So I'm going to ask for a put option, and I think it's probably fair play for the entrepreneur to ask for a call option.
sounds like what I already kind of have built into my plan, so.
That's awesome.
Just want to kind of clarify.
We're about 15 minutes past. Are we, what's the game plan at this point?
We've got cocktails and things ready, so if people want to keep asking questions.
The Scots arrived! I love it!
I don't know,
Come on, Joe.
something a little lower level.
Yeah, the 25-year-old. So I think what we'll do is maybe break for that, but I know probably most of us will be here for a while answering questions. And, so thank you, everybody, for participating.